Hello, and welcome to Virtual Investor Conferences. My name is Cecilia, and on behalf of OTC Markets, we're very pleased you've joined us for our next live presentation from Data Communications Management Corp. Please note, you can submit questions in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I'm very pleased to welcome Richard Kellum, President and CEO of Data Communications Management, which trades on the OTCQX Best Market under the symbol DCMDF and on the TSX under the symbol DCM. Welcome, Richard.
Thank you, Cecilia. Appreciate it. All right, good to be on a call today. As introduced by Cecilia, my name is Richard Kellum. I've been with DCM for coming up to 3 years, and my experience or history about 37 years in the consumer goods world. Here's what I plan to take you through today. But before I go there, I just want to talk about this forward-looking statements and information disclosure. I will be obviously providing or may provide some forward-looking statements, so please take that into consideration in this disclosure. Here's what I plan to accomplish in a quick spin today. Who we are at DCM, what we do, how we do it. The acquisition, we had a sizable transaction back in April of this year. I want to take you through the details of that transaction. Essentially almost doubling the size of our business. A little bit of our bigger and better strategy, and I'm going to refer to results through Q3 and year to date. And then I'll turn it over for any Q&A at the end. Okay, so I'll speed through this pretty quickly. Who we are, what we do here at DCM. We like to say we help clients simplify complex marketing, communication, and operations workflow. Sounds like a lot, but we're in the communication space. And think of large, complex enterprises that have complexity in their communication. We kind of help simplify that complexity. I'll give you a few more details and examples in a minute. We've been around for north of 60 years. We work with 75% of large organizations here in Canada. We're principally Canadian-based. We do have some revenue in the U.S., about 5%, but those are kind of servicing large clients, Canadian clients that have some operations in the U.S. We work with large government agencies, and our revenue is quite sizable for the territory, for the area that we play in. We're just north of $500 million in revenue post the transaction that we completed. And I'll take you through those details in a minute. A little bit of what we do, and I won't unpack this entire slide here, but we do what we call seamless print and digital communications. So, think of anything that you may receive in the mail or pick up in a bank or transaction mail. A lot of commercial print, business communication mail. Big into labels, so we service and do a lot in healthcare, do a lot of large formats, so think of signage or window signs, and do a ton of kind of logistics and fulfillment. Think of large retailers or QSRs that have multiple number of outlets, the kitting and fulfillment to those outlets. A lot of our print and digital communication is delivered through technology. I'll get into that in a little bit more detail. And we do also have a group in-house that we call our Marketing Strategy and Creative Services Group. So anything you need from a strategy or from a creative standpoint, we can certainly satisfy those needs for clients as well. A lot of our workflow is supported by technology. We like to say that the more complex the client, the more technology we need to build into that workflow to deliver, to simplify that complexity. So we kind of lean in hard, and I'll talk about some of our technology in a minute, to simplify complexity in marketing workflow with technology. Quick look at our clients. We have 8 key verticals that we work in, large in transportation. Financials are actually our largest vertical, just north of 20% of revenue, and we're working with all the Tier 1 banks here in Canada. As I mentioned earlier, we do a lot in healthcare. So think of kind of forms and labels and statements and all the paper you may see in a hospital. We're providing most of that and a lot of that workflow. quite active in retail, consumer health, energy, and QSR. So a lot of diversification, not a single client that is more than 6% of revenue. And again, kind of north of 250 clients across the Canadian marketplace, all at the enterprise level. We've got national reach across Canada, 14 manufacturing facilities, sort of coast to coast, again, to satisfy the needs of those enterprise clients. And a quick reference to our technology. Don't plan to get into this detail in 30 minutes, but as I said, a lot of that complexity that we deliver to clients to help them simplify the complexity is done with technology. If you see the chart here, we've got on the right side, that DCM Flex platform. That's a workflow automation platform that essentially helps to simplify the complexity and automates workflow. We're also in the digital asset management space. We also do personal videos. So think of personal direct mail that you make it to your house. We have the capability to do that in video delivery today, as well as a couple of other solutions that we bring to clients around OptiChannel. That's sort of kitting and fulfillment. Technology allows us to optimize kitting and fulfillment for large retailers, large QSRs, or anybody with bricks and mortar. So a lot of technology kind of underpins and supports our workflow. And maybe just a quick understanding for people that are new to the Canadian communication market. It's a $68 billion market. Just the printing portion of that, if we wanted to zoom in real quick, is about a $10 billion market here in Canada. You saw the numbers earlier, we're $530 million of a $10 billion market just in print alone. So we see sizable opportunities for continued revenue expansion just in the market that we're in here. Okay, I'm going to quickly jump into the acquisition of Moore Canada Corp. So Moore Canada Corp, for those that are unaware, was the Canadian division of R.R. Donnelley. Okay, so R.R. Donnelley, a massive, sizable global enterprise, and we essentially acquired their Canadian division. We call it Moore Canada Corp. We closed that transaction on the 24th of April. It was roughly they had about $250 million in revenue. The total transaction all in was about just over $130 million. That included some real estate. So think of it as $100 million for the business, about 4.5 times EBITDA, and $30 million for the real estate. And we since transacted most of that real estate. We fully funded it with Fiera Private Debt and Bank of Montreal. And then we've been working to deleverage very, very quickly. We did an equity raise on the 25th of May. We raised $26.1 million, and we also sold one of those pieces of real estate for $24.5. And then, of course, we've got strong cash flows. I'll show you how we've deleveraged super quick. So great transaction, essentially almost doubling the size of our business. Rationale was very clear: expanded our product offering, really superior service, gave us some new innovations, scale to invest, and we acquired a lot of incredible people as well. A little bit of information looking at pro forma financials if we had owned the company for a total year. Remember, we acquired them the 24th of April. But if you look at the first slide, or the first left-hand side of the slide here, revenue, $530 million pro forma revenue. So we went from $273 million here as a standalone business. We added that 250 or 255 to 530 in total. Gross profits obviously went to $135 million, and EBITDA, pro forma EBITDA, is around $65 million. So very, kind of nice transaction here to both build a bigger and a better business. We were very well prepared for integration. We used Boston Consulting Group for both the due diligence, pre-merger integration process, and some post-merger integration as well. We identified and communicated our synergy targets, and those are between 30 and 35 million across four areas: operational, organization, procurement, and revenue. I'll talk about how we're progressing against those. So this deal was done for obviously synergy value, but also for growth as well. Two large companies coming together, being a bigger and better organization in the Canadian marketplace. But some clear synergies to be delivered, and we're well planned against the delivery of those. Just having a look at the bigger business side. I'm going to jump to performance now through quarter three. Through quarter three, we grew 93.6%. Obviously, that was due to the acquisition, bringing the two companies together. About 122 million in revenue, about 60 million growth over a year ago. Year to date, again, transaction completed on the 24th of April. So year to date revenues 58.3% growth over a year ago, just approaching 320 million in revenue. And you can see momentum by the quarters here. We've had good, consistent growth quarter on quarter. And in fact, we've had 8 consecutive quarters of year-over-year growth. And some of the revenue growth initiatives, we've had good success in a lot of verticals, some good growth in healthcare and QSR, in manufacturing and retail. And you can see in this chart that our annualized revenue impact, we've added about 18 million in new business that through 2023 that will show up in 2024. Okay, so it's really good success bringing these two businesses together and delivering kind of solid new business wins at the same time. From a gross profit standpoint, gross profit up 52.4% on the quarter, about 30 million dollars versus 19 million a year ago. And you will note, maybe important to note, that the gross profit margin is 24.7%. We were 31.4% a year ago. And that's because the DCM legacy business gross margin 30, 31, 32, the acquired business 20. You bring them together, obviously your average is going to go down. But we've got some it's all part of the deal logic. We've got some very clear plans to move gross margin back up north of 30%. And this is an interesting chart. I don't plan to get into a lot of details, but it kind of explains what I just said. If you look at that blue line on the top, you can see that pre-acquisition, the margin for DCM legacy has sit in that 30 to 31 to 32 range and pretty consistent quarter on quarter. And you can see the acquired business. Again, this is all part of the deal logic as well. We knew there were opportunities to expand and improve the margin of the acquired business, but you can see it's a little bit lumpy through the quarters. Okay. Gross profit year to date up 42%, and you can see that year to date number as 27.1% in gross margin for all the reasons I said earlier. EBITDA up 28%, and we're about 9.6% of revenue at 11.8 million. And year to date, you can see we're north of 35% growth in EBITDA. And we're tracking to 12.1% of revenue. I'll talk what our EBITDA projections are when we talk about our five-year plan, which is what I'll close on in a few minutes. Okay, I'm going to skip that chart, and I'll skip that. This is just a path to $100 million in adjusted EBITDA. You can see that 41 million was the legacy DCM EBITDA, 23.6 million legacy MCC. So, add those two together. That's how you get to the 64. Synergies between 30 and 35 million. We see those synergies are what we call hard synergies, but we certainly see some growth synergies as well, which are in that, kind of at the low end, $1 million and, up to 5 million. And you can see a clear path to 100 million in adjusted EBITDA pro forma, which is what we're targeting. A little bit on the better business side, we continue to drive hard on SG&A, or productivity improvement. And obviously you're seeing a growth or an increase, but if you look at the percentage, it's actually down versus a year ago, down to 20.4% versus 21.5%. So building a better business at the same time. Year to date, 19.5% versus 23% 20.3% a year ago. Lots of work on driving productivity improvements. You'll see that in a chart coming up. We have had some one-time restructuring costs, and the best way to think about it is we've got it mapped to 1-to-1, so $30 million in synergies, $30 million in costs, and you're seeing some of those costs obviously flow through in the last quarter. This is what I was referring to in terms of productivity. You can see the productivity improvements we made as a company at DCM Legacy, down from 1,400 associates to 910. Obviously, acquisition brings us up to about 1,800, but you can see the productivity per associate or revenue per associate increasing from 225,000 up to 306,000. And we see a path to well north of that as we continue to deliver those synergies and deliver that integration and revenue growth. Also proud of our ESG efforts, and one thing we're particularly proud of is our reforestation program. Essentially, for every 83 pounds of paper we use for clients' workflow, we put a tree in the ground. And since we entered in this program, which was about a year and a half ago, we have reforested about 1.1 million trees, and certainly our clients are very pleased with this, and we flow those credits through directly to our clients as well. I showed you some of the solutions we had earlier, our digital solutions. We generate in the last 9 months about just under $10 million in revenue from those solutions. That's kind of direct revenue, combination of software fees and service fees and program management fees as well. And you can see the growth at 255. So we're kind of all in to continue to deliver that accelerated growth agenda on our technology platform. Total debt reduction, as I said, we've been deleveraging very quickly. We were at $143 million when we closed the transaction, down to 117. And then our net debt, you can see 126 post transaction completion, and we're down to 95. So we're sitting. James, our CFO, is right across from me. I think we're just over 2 times leverage right now. Okay, and we'll see that deleverage very quickly. Okay, some closing remarks. We've got a very clear 5-year strategic plan. We can see a path to a 5% organic revenue growth over the next 5 years. I did reference our EBITDA objective, so we see a path to north of 14% EBITDA. Once we get through the integration, our adjusted EBITDA should be the same as our EBITDA once we're complete integration, which will be about 1.5 to 2 years from now, so by mid-2025. We see continued expansion, acceleration of our MarTech solutions. We do have a plan to get revenue to $1 billion over the next 5 years. That would require some smaller acquisitions, and certainly intend to do those as long as they make strategic sense and good value for shareholders. And then our debt to EBITDA, we've got a target to deleverage very quickly and get below 1 times. Okay. A little bit on capitalization and ownership. We've got 60 million shares fully diluted. You see directors and officers about 28%. We've got our employee share. We have an employee share program. It's about 3% of the float. We've got one sort of family office called KST Industries that owns 8.6. So a lot of kind of inside shareholders here. And then we have some, sizable institutional investors came in when we did that transaction in May, that share offering in May. And then, of course, we have some sizable retail shareholders as well. Okay. So yeah, why invest in DCM? Look, we've got great clients. We've got good solid revenue growth. This is a chart we had from a year ago. In 2022, we grew organically at 16.3%. So it's a big market that we play into. We've got clear digital platform. We've got a clear, unique selling proposition in the marketplace that really does add value to clients. We're all in an operational focus. We've got a very deep leadership team, a lot of experience in the industry, amazing cash flow. We know how to deleverage quickly, and we're proving that already. Within the first kind of 7 or 8 months of completing the transaction, and I think we're well skilled on integration, so M&A execution, and we're certainly seeing that as we digest and we integrate this large and sizable acquisition here of MCC, and then we're well prepared for any future acquisitions that we may do. Okay, so that is my presentation, and I'm going to see if we've got some questions, which we do. I've got a question here. Any plans to expand into the U.S. market? Great question. As I said, we are in the U.S. right now with a couple of clients that are Canadian FI clients that have businesses in the U.S. So we are there, about 5% of revenue. We certainly see opportunities beyond that, but we are going to play to our strength here in the Canadian marketplace. The Canadian market is a $10 billion market. We're $530 million of a $10 billion market, 540 million of 10 billion. So lots to play for here. Although we'll certainly consider opportunities south of the border, but not at the expense of delivering solid revenue growth here in the Canadian marketplace. But a great question. Key milestones for 2024, and what do you see as growth drivers outside of M&A? So let me ask the second bit. Market's a $10 billion market. We have mapped the profit pools and the margin pools for every one of the sectors of the market. So not all are treated equal, of course. We want to play to the high value margin pools and the growth margin pools. So for an example, personalized direct mail is a sizable margin pool in the industry here in Canada, and growing. And we're well positioned both from a commercial capability and from a capital capability to play into that market and deliver success. So we see a lot of opportunities in the Canadian market to grow our share in the high margin areas, as well as expand beyond the 8 core or key verticals that we play in today. Okay. Another question here. Did you pick up financial printing from RRD? Short answer to that is yes. Here in Canada, we do financial printing. We do all the, call it, BCS, Business Communication Solutions, and we've got a couple of facilities that came with the transaction. We essentially acquired the entire Canadian business. So yes, we do have financial printing from RRD here in the Canadian marketplace specifically. Okay, another question. Can you speak to your debt levels? Also, how did you finance the Donnelly acquisition? So James is right across from me. James, you want to just take that on real quickly?
Sure. We financed the acquisition with a revolving credit facility from BMO Bank of Montreal, which is our kind of lead provider, as well as a $50 million term facility from Fiera Private Debt, which is a private debt partner that we're very close with. So think about $130 million of financing. About 30 million of that was related to 3 owned real estate facilities that we acquired. And our intent is to sell all 3 of those and use the proceeds to pay down debt. So far, we've completed 1 transaction. We sold our Oshawa warehouse that we acquired, did a long-term lease back on that facility. That generated a little over $23 million of net proceeds. So that was used to pay down debt. We have purchase and sale agreements for 2 other facilities, one of which we expect to close in the next couple of weeks, and the other we expect to close in January. In aggregate, those facilities will generate about another $15 million. So think of us as kind of coming in around $36, $37 million kind of net proceeds on about $30 million of kind of notional capital there. So we're well on track to pay down debt there. We also did an equity raise, which Richard mentioned earlier, generated $26 million, and that was also used to pay down debt. So very committed to paying down debt going forward.
Okay, so great questions. I don't think there's anything else in the queue here. Nope, that completes the questions that are in the queue, and we're pretty much right on time, unless there's any other questions that come forward. Okay, thank you for the opportunity. James and I are available anytime if you want to reach out and ask any other questions, but happy to tell our story. As I said, we've got a great business up here in Canada, and we're well positioned for success as we move forward and complete the integration of these two amazing companies. Thank you.